Welcome to Optimum Solutions Best Practices for Garnishment Processing webinar. My name is Susan Warren, and I'll be your presenter today. And Sherry Dwyer is also with me. We're going to talk to you about establishing best practices for your garnishment processing policies. It looks like we still have some more attendees to join. But I'm going to go ahead and get started. Let's take a look at our agenda for the day. We're going to look at the life cycle of a garnishment while it's in your house, which of course is really the only time that it matters to you, the time that you need to be sure you are handling it correctly. And we'll also look at what rules and regulations apply, when and where, and how you can find those rules. We'll look at what you should do as soon as you receive a garnishment order. And that's when your best practice actually begins. And then we'll look at some specific examples of child support orders and federal tax levies. We'll spend a little bit of time on federal student loans and creditor garnishments and wage assignments, as well as taking a look at some cautionary things that you need to be on the lookout for these days. I want to spend a little time on this slide because this is really the meat of best practices, and I suspect it's a little bit small for you, so I'm going to point and read some of the topics here. But this slide shows what I call the life cycle of a garnishment while you have it in your house. From the time you receive either the snail mail or the email order to withhold income from your employee, through all of the paperwork that you have to read and interpret, and then the actual calculations and withholding, then of course the disbursement or the remittance to the receiver, and then your inevitable phone calls and follow-up. These are the tasks that you perform when you're processing a garnishment. So first, you receive the order. That may be in your mailroom. If so, make sure that your mailroom is using a date and time stamp. If paper orders are scanned, that should automatically date and time stamp. Now, if your mailroom then delivers mailed orders to your payroll department, best practice calls for your department to also use a date and time stamp again. Why? Because garnishments are very often first in, first served. If your orders are electronic, that will also take care of date and time stamps. But once you receive the orders, file them in your established filing system apart from the employee personnel files. Then you need to read and interpret those orders. Carefully read the withholding orders to identify the type of order and answer some questions regarding how to handle the order. Is it new or a change to an existing order, or maybe even a release? Does it apply to an active employee or a terminated employee, or an employee who never even reported to work after you made them an offer of employment? Do you need to follow state or federal regulations? You need to show the order to your legal department. Maybe they need to help you interpret, or you need to get their opinion about what to do with this order. Or do you need to contact the agency that issued the order to clear up something that raises any questions? Or, in the best case scenario, the last block here, is everything standard and normal, and you just need to send the order straight to payroll data entry to get the information into your system? Now, as soon as you receive an order, you should notify your employee that it's been received. And this really should not come as a surprise to the employee, no matter what they tell you. Most non-custodial parents are aware of the existence of the child they owe support for. And employees who owe taxes have gotten probably 100 notices from the IRS before their employer ever receives an order of garnishment. So don't let them tell you they had no idea. You are obligated to withhold according to the order, so you have no choice no matter what your employee says, and you must explain that to the employee if they question you. And the employee is always free to contact the agency that issued the order. You will also probably have to send back some answers to interrogatories and perhaps even have to have responses notarized to send back to the agency that issued the order. Know your state rules. Sometimes federal rules apply to withholding orders. Sometimes state rules apply. The rule that will apply will always be the rule that is most favorable or applies the most protection to the employee. And we'll discuss state rules a bit more in a few minutes. When you're ready to calculate, first thing you usually have to do is calculate disposable earnings, and that's something else we're going to discuss more later. And we'll talk about what to do if there are not enough earnings to fulfill the garnishment obligation when you make the payroll deduction. Then you're ready for disbursements. Create payee checks or electronic funds transfers through payroll, or send payment requests to accounts payable. Now, Georgia, Ohio, and Oklahoma require some special forms to accompany some payments. So if you've got child supports in those states, watch out for those. If multiple employees' deductions are included on a single remittance check, attach a list of individual employees included in the lump sum payment. Mail paper checks and supporting documents. Make sure that the agencies where you're sending this information is actually receiving and cashing your checks. Checks that got lost in the mail should follow stop payment procedures and be reissued. Keep the GL accounts for the garnishment payees as well as the payroll bank statement reconciled. And if you have a payee who is not cashing your checks, you should follow up. On the other hand, if you have a payee who is not receiving your checks, you better believe they will be calling you. So you're going to have phone calls that you'll need to handle. Perhaps it's employees with questions that will contact you. There could be lost checks, misdirected electronic funds transfers, interrogatories or responses to questions that got misplaced or not completed. You may get orders for employees that cannot be met, and you just need to make phone calls. It's all part of the garnishment life cycle. The Consumer Credit Protection Act, or the CCPA, was issued by the Department of Labor's Wage and Hour Division, and it places limits on the amount of an individual's earnings that may be garnished, and that's different for different types of garnishments. The CCPA actually does a lot of things, but these limits are probably the most important thing to us today anyway. And next most important is that it states that an employee cannot be fired because the employer received an order for a garnishment. CCPA also defines earnings, and it defines disposable earnings as the amount of earnings left after legally required deductions are made. So everybody asks, well, what are legally required deductions? And usually that refers to taxes, deductions that the employee has no choice in whether or not they get deducted. It does not include things like direct deposit. So when your employee looks at his direct deposit stub and it shows a direct deposit as a deduction so that his net check amount is zero, no, that is not a deduction that is used to calculate disposable wages, no matter how much your employee argues with you. Something else the CCPA does not do is place limits on garnishments for certain tax levies or bankruptcies. The CCPA, or federal law, sets the following limits on the amount of disposable earnings that may be garnished for: child support, up to 50% if the employee is not supporting another family, or 60% if the employee is supporting another family, or 60% if the employee is not supporting another family, and it allows for an additional 5% for arrears. Limits on garnishments are the lesser of 25% of disposable wages or the amount over 30 times minimum wage. And for student loans, the limits are up to 15% of disposable wages or 25% of disposable wages if there are multiple loans. So let's start with the actual receipt of the order. Again, be sure that your mailroom is using a date and time stamp. And an even better practice is to date and time stamp that order when you receive it in payroll. Collectors run a race to payroll because for many of them it is first in, first served. So you need proof of when you received that order. The next thing you'll do is interpret the order once you receive it. It may be brand new, but it may just be a change to an existing order. And then again, it may be a release or something that you need legal assistance or clarification on. Always let the employee know that you have the order and then answer any questions that came with the order. The actual income withholding order, or IWO, has been standardized by the Office of Child Support Enforcement for child support withholding orders. They have also standardized the process and established state disbursement units in all states except South Carolina so that remittances are now centralized. Child support orders take priority over all other deductions except federal tax levies already in place prior to the date of the child support order. But if you receive a child support order when a tax levy is already in place, call the tax agency and explain what has happened, because typically the tax agency will allow the child support order to take priority. Disposable wages for child support are normally gross wages less taxes. Wage assignments are not deductions required by law, so they would not be used to reduce gross wages for the disposable wage calculation. However, medical coverage that a non-custodial parent is ordered to purchase for dependent children can be used to reduce disposable wages. But the employee premium should not be exempt from the garnishment. And the Office of Child Support Enforcement has standardized this National Medical Support Order and the process for that. We've already talked about the CCPA limits of 50, 55, 60, and 65% on child support orders. But be aware that some states have different rules, and the work state sets the limit. For example, in Texas, there's a 50% cap on child support, so you can't withhold more than 50% for child support in Texas. Child support withholding should start the first pay period after an employee has worked 14 days or sooner if the state law requires it. Work state sets this rule, and if the employee works in multiple states, you need to follow the rules of the state where state unemployment is paid. Stop withholding only when you receive appropriate notification from the appropriate court to do so. And speaking of stopping child support orders, we're getting very close now to the time when those old friend of the court child support orders are sort of aging out of the system, but you may still have some of them. And you may be paying those to a sheriff or a custodial parent or an attorney or a county judge, something like that. And sometimes those older orders did not specify when the order was to end. So you may not receive a stop order on those. You may have an employee come to you and say, the child has graduated from high school or even college, and could you please stop withholding child support? And of course, your answer to that employee is no. But you can call the agency to whom you are making the payments and tell the employee to do the same. And once you receive appropriate stop orders, and it may just be a copy of the child's high school diploma, but that's probably good enough if it's come from the right court, you can stop the withholding. The state that sent you the order should tell you where to remit payments. Lump sum payments to employees are also considered wages and are subject to child support. Incentives, vacations, stock options, commissions, these should be subject to child support as long as the per period maximum has not already been satisfied. If you've got an employee who got their regular check for a week, and in that regular check, the total child support was withheld, and then in the same week they get a bonus or some other kind of lump sum payment, then you would not need to apply child support deductions to that bonus because you had already met the per period maximum with the employee's regular check. Back in the 1980s, there was a big uproar about non-custodial parents who were not paying support. So the Office of Child Support Enforcement was established, and in 1996, they introduced new hire reporting. And this whole program has worked very well. You should be reporting all of your new hires to a state where you have nexus, and I would advise that you choose the state with the simplest requirements because not all states require the same information for new hires, but you only have to report to one state, and then they will report to the federal system, who does an amazing job of notifying employers when an employee is hired and needs to have a child support order served. Likewise, you should be reporting your terminations to the state disbursement unit where you're making those payments. If you have an employee who goes out on leave due to an injury or an illness, notify the state disbursement unit where you've been making those payments and give the workers' comp or disability provider the contact information for the state disbursement unit. Work state sets the maximum amounts you are allowed to charge employees for processing their child support payments. One thing you need to be wary of is mail that you receive from collectors that are misrepresenting themselves. They have become very clever these days with their names, and they may appear to be state agencies, when in reality they are only private collection companies. So watch out for that. And then you can always visit the Office of Child Support Enforcement, and here is their website address. They have a great website that's full of a lot of information, and I'll be referring to their website again in just a few minutes. Let's look at some examples of how to calculate child support. Now, when there's just one order, it's pretty simple. You calculate disposable earnings, gross less taxes, and then take the dollar amount that the child support has ordered. or as much as you can take if there are not enough wages to fulfill the order. But when there are multiple orders for one employee, it's a little more complicated. So those are the examples I want to show you because you do the calculations differently for different states. In our example, we have 2 orders for one employee. The first order was for $450, and then the second order that we received a few months later was for $300. Now, the max that we can withhold on our employee, remember the Consumer Credit Protection Agency max is a 50 or 55 or 60 or 65%. For this employee, in our example, our max works out to be $600. The first type of calculation I want to show you is the Prorata calculation. This slide says Indiana, for example, but almost all states use this Prorata type of calculation for multiple child supports. And in your Optimum Solutions applications, you would accomplish this with receiver deductions. And you can ask your support rep if you don't know how to do that. Here's another address that you can visit. This is on the Office of Child Support Enforcement's website. And there you can get a complete list of all of the states and how they mandate that you allocate orders when there are multiple orders for a single employee. But in our Indiana example, and almost every other state, our prorated calculation would look at the first order of $450 plus the second order of $300 for a total of $750. The first order is 60% of the total, and the second order is 40% of the total. And I got that by taking the first order amount of $450 and dividing that by the total $750 for all orders. And that's where I get 60%. And then on the second order, the order itself divided by the total of all orders gives me 40%. So 60% of the total $750 is $360, and 40% of the total $750 is $240. So those are the 2 amounts to withhold for these 2 orders. In Texas, Guam, the Virgin Islands, and the state of Washington, you're required to allocate multiple orders equally. So in our example where we can withhold a maximum of $600, each order gets an equal share of $300. In Montana, they have that first in, first served rule. So the order that came in first is served at 100%. And whatever's left over, if anything, can go to the second order. So in our example, out of our $600 maximum allowed, the first order gets completely fulfilled at $450, and that leaves $150 to go to the second order. So do check your state allocation rules to see which rules you should follow for which state. Let's look at federal tax levies, and they take priority over all other garnishments except for child support orders that were in effect prior to the levy. And again, if you get a child support order for an employee who has a tax levy in effect, I suggest you call the levy agency and see if they want you to give priority to the child support or not. For a tax levy, you'll receive a 6-part Form 668W with lots of instructions, and Part 3 has to be returned with your first amount that you remit. You should never stop withholding a tax levy until you receive Form 668D, Release of Levy, because you don't know how much interest or penalties the employee may have accumulated. If you get a Form 668W for an employee who is already terminated, indicate that on Part 3 and return that to the IRS. And if an employee terminates while a levy is in effect, notify the IRS office where you've been sending payments. If you do not withhold and pay amounts that you should be deducting for the tax levy, you will be liable for the amounts that you did not pay plus a penalty. Now, don't think that if you're liable for those amounts that you're paying the tax levy for the employee. That's just your penalty, because the employee will also still owe the levy as well. And I know it's small, but here's a picture of the tables on Form 668W that show how to figure how much an employee is allowed to take home for a tax levy depending on filing status and number of exemptions and pay frequency. You're probably all familiar with this form. Here's an example of a calculation for a married employee filing jointly with 3 exemptions. The table that we just saw stipulates that this employee may have $955.77 that is exempt from the levy. Any voluntary and involuntary deductions in effect before the levy may remain in place. So our biweekly wages are $1,500, and then we have all of our taxes and the deductions that were already in place. So our total to subtract from the wages is $334.75, and that gives us a net of $1,165.25. And from that, we subtract the $955.77 that is exempt from the levy according to the table that we just saw on the previous slide. So that leaves $209.48 for this federal tax levy amount. Federal student loans, which we're seeing more and more of these days, have a maximum deduction amount of the lesser of 15% of disposable earnings, or the amount over 30 times federal minimum wage, unless there are multiple loans, and then that 15% changes to 25%. Child support orders take priority over federal student loans, and the employer is supposed to give 30 days notice before withholding. I understand that that's actually pretty difficult for the employer to do, so just do your best, but that is the official instruction from the Department of Education. And the Department of Education will notify you when you should stop withholding. So don't ever stop withholding a student loan just because you think they've paid off the loan. There may be penalties and interest that you don't know about. And it is unlawful to terminate an employee because of student loans. Here's an example of a federal student loan calculation. We've got our weekly wages less our taxes. There are some other deductions that we actually can't subtract from our wages in this case because they're voluntary, and federal student loans are just based on disposable. So our disposable earnings, gross less taxes, are $803.50. So we multiply that by 15%, and that gives us $120.53. Or we take our disposable wages less 30 times minimum wage, and that gives us an amount of $586. So the lesser of those two amounts is $120.53. So that would be our withholding for the federal student loan. Let's take a quick look at creditor garnishments. There are 3 parties to a creditor garnishment. There's the creditor, the debtor or the employee, and the garnishee or employer. The maximum allowed by CCPA is the lesser of 25% of disposable earnings or the amount over 30 times federal minimum wage. You may charge administrative fees for processing creditor garnishments, and maximums are set by state laws. Federal, state, and local employees are exempt from creditor garnishments unless specifically provided otherwise by state law. If you receive an out-of-state order for a creditor garnishment, you still must comply if the garnishment order has been registered in a court in the employee's work state or if the employer does business in the state of origin of the order. And here are the garnishment limits based on frequency for creditor garnishments. In our example on the next screen, we're going to fall into this category here in the bottom left where our disposables are $290 or more. So our limit is going to be 25%. And here is our example of a creditor garnishment calculation. Disposable turned out to be $310 a week. So the maximum to withhold is 25% of $310 or $77.50 or disposable less 30 times minimum wage, which is $217.50. And that gives us a garnishment of $92.50. So we'll withhold the lesser of those two. In this case, the creditor garnishment would receive $77.50. Wage assignments are not covered by the CCPA, so there really are not limits. Probably the most common example of wage assignments these days would be payday loans. And folks can get into serious trouble and end up with interest rates of 600% or higher. A wage assignment is an agreement that an employee signs authorizing his or her employer to withhold a certain amount of wages and assign those wages to a third party. Federal, state, and local employees are exempt from wage assignments unless a state law allows otherwise. You have the right to question any order that does not appear regular on its face. If you don't think it has come from an appropriate issuer, or it's been signed by an appropriate official, or if things have been altered on the document, do not hesitate to question anomalies. It is your job to follow the law. Be on the lookout for private loan collection agencies who have names with words like federal or state. They're very creative these days. And don't fall prey to a bully. There are attorneys and collectors who will tell you that you are wrong and try to threaten you, but you have to know your laws, or at least know how to contact your state office of the Attorney General to find out what is right. And never take your employee's word that their debt is paid in full. Always wait to stop when you get appropriate notice. Thank you for joining us today. We hope you've learned some tips about best practices for garnishments. Please be on the lookout for more of our educational webinars coming soon, and have an optimum day.